This conference will now be recorded.
Hello, this is Matt Mayers and Kevin Cochran from Hunter Street Investment Advisors. We hope everyone is having a great summer, and we do thank you for taking the time to join us here today for our 2022 mid-year economic outlook. As I mentioned, I have one of my partners, Kevin Cochran, here. Kevin, how you doing this morning?
I'm doing great. Played pickleball this morning at the crack of dawn, and here we are. I just got off the telephone with a friend of mine who's another financial advisor here in town. And, of course, we're talking about inflation, right? And housing prices and rising rents in this area. And he was telling me about a client of his, and this guy had to move out of his house because rents have gotten so high. And he moved into a bouncy house.
A bouncy house?
A bouncy house, if you can believe that. A lot less rent to start with, but the rents are going up there too. Of course, the good news is it's all due to inflation.
Oh, but to Kevin's point, inflation is no joking matter right now. And I will tell you this, is we always like to start our presentations off with a little bit of a story and a joke. That's our premise to you. Whether they be cheesy or not, we're always going to start with giving you a laugh. We hope that you enjoyed today's presentation. We're not going to keep you for more than about 15, 20 minutes, but this is something that we hope to continue maybe several times throughout the year, at least depending on what we see happening in the markets and the economy. We do think, Kevin and I were talking, and Joe and Mike were talking, that we do feel this is probably one of the best times to be able to reach out to our clients if you're a client of ours. And if you're not, we hope you find some of this information valuable. If you're out there kind of navigating on your own, or you're with another advisor, please take the time to listen to this. The information that we deliver today is not going to be anything about products or anything like that. We just wanted to put some thoughts out there with regards to what we have seen happen in the course of this year, and really what we see happening through the remainder of this year into next year. And I will say this, we are not crystal ball experts. So it is not going to be, I don't want anyone to think that, because Matt and Kevin said this is the way it's definitely going to be. But I will say this, is there's some trends out there that we see that we are definitely paying attention to. And if you're not in the financial world like we are, maybe you don't have enough time in a given day to really analyze all these charts and trends. So we're going to share some great information with you today. So we thought the inflation joke was a good way to start. But in a sense, it's not really joking, because we have felt tremendous inflation over the last 6 to 12 months. Beyond that, though, and I thought, what's a good theme to really begin this presentation? And I thought, what, I always like to start with a theme, something that you'll remember. Not that we're not memorable, but something that you're going to remember as you take away from this. And I thought, I'm going to share this picture with you and see if you all remember something like this. Kevin, do you recall what this movie was?
Back to the Future.
Back to the Future. And that is a very young Michael J. Fox, who I will say, God bless him, he has his health issues, but I saw a picture of him the other day and he still looks fairly young, but he's doing okay. But this movie was Back to the Future, and it came out somewhere in the 1980s. Do you remember what year it came out?
I don't. I would guess 82.
Close. It was 1985. So I share that with you because obviously, if you grew up or you were alive in the 1980s, you probably are familiar with these movies. There were several of them, but I really like the theme of the movie, which is Back to the Future, because I do think that what we are experiencing today, we can actually go back into history, take a look at some things that have happened in history. And it's not necessarily going to predict 100% what's going to happen in the future, but I think it's a good tale of some of the things that we may see coming down the road, and also some ways that we might be able to identify and put some strategy around ways to kind of alleviate some of the cautions and concerns that we have. So I'm going to label this Back to the Future. Now, I thought about this, 1985. What was going on in 1985? And a couple of tidbits that jumped off the page at me. 1985 was the year the first CD was introduced. I don't mean the bank CDs. I mean the CDs that we put in our car. I think there's still some cars out there that have a CD player, but that was the year the first CD was introduced. And I joke around now because I laugh. My kids don't even know what a CD is. I think they forgot because everything's on iTunes and things like that now. It was also the year that Microsoft version 1 was introduced. So if you can think back that far. So, a couple of little tidbits there back from 1985, but, let's take a step back and think, what were the markets and the economy like in 1985? 1985 from now was very, very different, but the stock market in 1985 was one of the best stock markets that they had seen in over a decade. And one of the main reasons was, and I like the caption is, it was because of easy money. And I keep thinking, does that sound familiar? Does easy money these days sound familiar? Obviously, we have just seen a wonderful stock market over the past couple of years, leading out of one of the worst pandemics we've ever seen. But the market has been soaring up until obviously this year. Then the other thing is interest rates. And we've been talking about the Fed, and I know everybody's talking about the Fed, and we're going to share some thoughts on the Fed here later on today. But the Fed fund rate, if you're familiar where that is right now, it's still under 2%. In 1985, it was 8%, a little bit higher than it was today. But I say that lightly because in 1980, I don't know if you were investing or growing in the 1980s, you probably remember inflation was a little bit higher than it is today. I know it seems high, but the Fed fund rate in 1980 was 20%. So we were in a different time period in 1985. The Fed was coming down. We just watched the Fed, and they're still doing it right now, tightening things up a little bit, right, to help choke off inflation. 1980, the Fed fund rate was 20%. They were doing that to cut off double-digit inflation, and then ultimately over the 5-year period, they were coming down. So I tell you that because however painful it feels right now, eventually when the Fed's done raising rates, they will stop, and they will begin to ease up. So it just happened. So, I can't say the interest rate environment was the same as it was in 1985, because obviously we're on the other side of that. The reality is, if we're really talking about back to the future, this period looks a lot like the early 1960s. Okay, 1960s, we were just coming out of a double decade of lowering interest rates, ultra low interest rate environment, and we were heading into that kind of Cold War era. And when we look at kind of some of the things we're dealing with right now, just even outside of the U.S., some of the geopolitical things, it's not very different. So I tell you that because there's a lot of lessons that we can learn from things that have happened in the past. So today, we are going to go, before we go back to the future, Kevin and I are going to give you a little bit of an idea of what happened. And I say that as recession, maybe or maybe not. That's probably the biggest question that our clients are asking us, Kevin. I'm sure the same with you, is when do you see a recession coming? Is it coming or is it not? Will we skip this one? Is it going to be horrible? Is it going to last 2 years, 3 years? The reality is we don't know when the recession is going to come. We have some good ideas around when it may start. The level of recession is really out of our hands. And I say that all the time. It's out of our hands. Recessions are really driven by, and I'm going to show you some thoughts today, other than things like crisis and pandemics, recessions are driven by one main entity, if you will, and that is the Fed. So we're going to show you a little bit about how that comes about. We are going to look, as I mentioned, back to the future, lessons from the past, and then how they can help us prepare for the future. So I will say that if you're not, some of this might sound similar. If you're a client of ours, we just went through our quarterly reviews. If you're not a client of ours, take some notes. We're going to actually, we'll send it, obviously we're going to send this to you, but just take some notes. If you haven't seen this type of information before, and you really are not getting this type of financial planning, we would encourage you to at the very least, reach out to us, even if you have just basic questions, and see how this might be applicable to your scenario. So the first thing we're going to look at, it's been a challenging backdrop for markets this year. Kevin, I hate showing the slide. I hate showing the slide because I don't like talking about things that are not things, bad things that have happened in the past. But the reality is, I do think it's important to know what just happened here and why it happened so quick. Because I think that's the biggest challenge we faced here, is that this first quarter didn't just happen. It was something that happened. We had all this great market, and then suddenly everything went down. But there was a reason behind it. If you look at where our markets were this year, it started with inflation hitting 7% for the first time in 40 years back in early part of this year. Then we had Russia invade Ukraine. Obviously, that was not helpful. The first Fed rate hike since 2018 happened in March. And then we had U.S. report negative GDP growth for the first time in a long time in late April, early May. And then what that means is, we always say, how does that relate to the stock market? Clearly, when all this stuff is going on and fear and emotion take toll, that's not going to speak well for our stock market. With the S&P down 21%, and we're entering bear market territory. So that is what happened in the first quarter. What it amounted to is something that is, I think probably we haven't seen in 40 plus years, which is a market sell-off that erased $3 trillion from U.S. retirement accounts in a matter of a quarter. Okay, so I'm talking about everything, not just 401k plans, everything. 401k plans lost $1.4 trillion. Now, that doesn't mean that 401k plans are bad. It just means that 401k plans are a great place to be be building wealth for retirement while you're working, because you're making money, you're making money, you're putting it into it. But a lot of 401k plans are not designed to handle market volatility. They're designed to handle a specific time that you're going to retire. I put target date funds hit the worst. There's so many times we see clients come in there, we're saying, let's take a look at your 401k allocations, because we do that. We will help our clients review their 401k allocations to make sure they're allocated properly. And they'll say, well, Matt, we're in one fund. You know, what's wrong with that? And there's nothing wrong with it, but target date funds are set around the day that you're set to retire, not diversification and not active management. But the one silver lining we see in this, and Kevin and I were talking about this the other day, is the savings rate has soared. So what people are saving into their retirement plans has gone up. We're seeing it with our clients. We encourage our clients, especially at times like this, when they can buy things at a discount, when the market is so low, it's good to begin saving more money. So if you look at this, so from a retirement plan perspective, 401ks, 403bs, we have the shift has come where now the savings rates come in around 14% between what employees and employees are doing. And that's a good thing. If you stopped saving in your retirement plan, if you stop contributing to your IRAs, your Roth or your traditional IRA, and you have time to go, this is probably one of the times you want to really reconsider and really look at what your things. And we're not saying put in more than you can, but it's not a bad idea that if you've kind of held back a little bit because of what's happened, now's the time to maybe change that.
For sure.
So that is what happened in the first quarter. Now, we mentioned inflation. Again, it's not a joke. I just wanted to show a couple quick slides of inflation here because I do think it helps put it into perspective. Inflation in this chart, there's basically the blue line, which is gasoline and food prices, and there's inflation expectations. That simply means what we think inflation is. So that pink line really is telling everybody, here's where we think inflation is. Is it higher or lower? Now, what I like to look at, what I think is interesting about this slide is that our view and expectations of inflation is very similar to the prices of food and gas. Mm-hmm. And obviously, that's one thing I think we can all accept has hit us tremendously over the last 3 to 6 months is food and gas prices. And Kevin's going to talk about that here in a second. But the gray areas show recessions. And the one point I wanted to make about this slide is if you look at the recession, we go back to the technology bubble, we go back to 2007, and we go back to COVID in 2020. Take a look at where food and gas prices were and where inflation's level were in reference to when the recession starts. Okay, that's all I would like you to take from this slide, is that we see a peak. This has happened before. We see a peak, and then what does the Fed do? They begin raising rates to choke off inflation. But you'll notice they're either already, the peaks are very close to, if you will, when the recessions have started, if not quite before. And the reason that I think that's important to know is that, and we were talking about this yesterday too, and this is a point we have to remind ourselves too. When is the recession? When is the recession? There's many times when we're in a recession and we don't even know it. Things are happening. You look at that period of time of 2008. You know, sometimes we'll be 6 months into a recession, and suddenly, guess what? We don't even realize we're there. We're still thinking, is the recession coming? Is recession coming? So I just ask you to consider that. We're not saying a recession's here, because again, if you look at that slide, we're definitely in higher inflation, but there is some time there. But if you look at that gray, there's definitely a period of time where we could say, you know, we're going to be stepping into this probably, and we're going to be realizing these things, and already the Fed's going to be making those moves to track those rates down and bring us out.
Make a quick comment?
Absolutely.
So notice here on the chart that the inflation expectations that we're seeing right now are in the range of 4%. Okay, that's not 6, 7, 8% that we've been seeing, and that is consistent with every market strategist that I've seen. I think Chairman Jay Powell's expectations are for it to be even a little bit lower, even in 2023. Okay, and so you're talking about inflation in the 4 to 5% range. I think you've got a chart showing wage growth, which is even higher than that. Okay, so that's why we're still okay. That's why consumption is held up. People are still having good wage growth, even in the face of inflation. That's not a tragedy. We can live with 4 or 5% inflation for a little while.
And Kevin makes a great point, is that inflation's up, but people are not stopping to spend. They are not holding back. People are traveling more. I mean, this summer, this summer, it's like July 4th came. I feel like there's nobody around. Everybody's gone.
Well, I ask my clients, do you know anybody not going to the beach this summer? I mean, everybody I know is going to the beach this summer.
So that's just something to look at with inflation. But, you know, one of the things we definitely want to be cognizant of, and this is, you know, I hope you remember this chart, is that we're not saying we're out of the woods yet. But we're also not saying we're in recession yet either. Okay, this chart basically is showing us what the Fed has done historically to fight inflation. Now that Fed fund rate, as I mentioned, we're still under 2%. Now all the way to the left of the right of the slide, you'll see kind of that dark blue. That's where it ends before we hit the light blue. That's where we are today. Now to Kevin's point, Powell and everybody were estimating this to be, instead a little lower than 4%, I say about 3.75, 4%. That's where we're going to be in 2023. My point of that is that we're not there yet. Now, there's a lot of concern, and I think there was a lot of concern around how quickly and how robust our Fed chairman was doing those rate hikes. You know, we expected to see a quarter, then it went to a half, and like, oh my God, it could be 75 basis points. So what typically happens in a rising rate environment, and again, this is historically the way it would work, is that there's usually a period of time where there's a couple of initial reactions, there's a couple of initial interest rate hikes, a quarter, and then if it needs to be more, it gets a little bigger, which is exactly what's happening now. This is nothing new. I mean, yeah, it seems like a sizable move because it hasn't been done in a while, but this is not a new Fed strategy. And again, we think they probably could have done it a little sooner, but that's neither here nor there. So they're going to come out with a little bit higher in rate hikes, probably over the summer through September. And then what you're going to see is they're probably going to taper off back down to those quarter hikes. So I tell you, it's not going to be 0.5% through a year. It's going to stop, and eventually it will level off, and then again the easing period will come. So my point is there's time between now and then. So we're not anticipated, if you see here on the edge of the slide, to get to that level until well into 2023. What's interesting though is if you look at these gray periods, again the recessionary periods, and take a look at where the Fed fund rates were. Remember we talked back to 85, I said back to the future, there's your 8%. Okay, look back as we creep up to the 90s, we're almost up to 10%. And then look what's happening here. There's a period of time between this and this before the recession starts. Okay, so if you see there's a little bit of a plateau, okay, and a little bit of a drop. You have a little bit of a plateau here, and you have a little bit of plateau here, a little bit of a drop, and the exact same thing here. So what that tells us is that recessions aren't overnight when the Fed starts ticking up interest rates. And if you look at these periods of time, so you just take a look at these last four recessionary periods, the average time it took from when the Fed did the first rate hike, okay, until the recession, the average period was 38 months. Okay, so when was the first Fed rate hike? April, or late March, early April. I'm not saying that's definitely going to happen. I'm just saying we're not at the recessionary period yet. And even at this level that we're talking about, to Kevin's point, we're nowhere near some of these high levels that we saw here in the past. So I think a great chart to kind of put that into perspective. But one positive that we've been seeing, thankfully, is the fact that oil prices have recently declined.
Yes.
So Kevin put this chart together. I think it's a great way to kind of take a look. I know we're all feeling it in our pockets as we feel the gas.
You know, crude oil, WTI, we put this chart together, as you can see, earlier in the week. It was around $120 a barrel in late June. Here we are, not even 30 days later, and it's down 20%. So we're around $100 a barrel. I looked at it this morning. It's actually under $100. So, you know, this is really good news. The rise in energy prices certainly was a big factor in the inflation numbers. And every business, of course, almost every business has fuel as a significant input to that. So this is going to be really helpful going forward.
And amongst that, so another good positive we've been seeing.
Jobs, of course. You know, this is a great thing for our economy. We've got over 11 million job openings right now. Okay, I think we're going to look at unemployment a little bit here in a minute too. That's around 3.5%, and we've never in history had a recession with unemployment at 3.5%. And we've got 11 million job openings too, which is going to kind of keep that number down. So, you know, people that are struggling with the rising inflation and costs, they want some more work, they can go get it.
Absolutely.
It's out there.
Absolutely. And I think to Kevin's point, you know, when you look at, you know, beyond just the job openings, the compensation, we've been talking about this, compensation has soared. So we have basically, it's growing. When you look at kind of the unemployment rate, which was what this chart's showing us, so the unemployment rate is in blue. And then the natural unemployment rate is simply unemployment not linked to cyclical demand. And then you have just wages and salaries. Take a look at some of the parts of that scream off the chart. So look at that pink line versus the blue line right now. You have the unemployment rate, which Kevin said is down to about 3.5%. And I think this is great because it also solidifies what Kevin mentioned, which is if you look at the previous recessions, which again are in gray, take a look at where each recession came here with regard to where that line is. We've never had a recession when the unemployment rate has been at 3%. If anything, it's been hovering up over 4%. So there's still some time. Now, the other part about that is what we're seeing is, again, people are demanding more money at work because prices are up. So that's a lot of what we're seeing now is people are demanding more and companies are coming through with it more because prices are soaring. Now, again, what's going to have to change here to kind of level out that balance of wage growth to really get back to moderate is going to have to be the unemployment rate is going to have to go up a lot in order for that to change. So that's not something that's going to happen overnight. And it's not something that's necessarily having the unemployment rate go up overnight in the next 3 to 6 months that much. It's just not consistent with what we're seeing companies doing right now. It's just not consistent. Now, we're not saying it can't happen a year from now, but it's just not consistent. But you're probably going to need that unemployment rate to go up over 2% or even more before we start seeing that wage growth kind of moderate. So I tell you that because that when the unemployment rate goes up, that's when we have to start thinking about a recessionary period. But it's just not, it's really not at the doorstep right now. So that being said, there's the question, how close is this next recession? Which again, Kevin and I are not here to predict the day the recession comes. But we are here to tell you, as we go back to the, back in the past, what a cycle looks like. I mean, when we were learning our businesses 20 plus years ago, we always talked about the economic cycle. And I think it's great to sometimes just recircle back to that cycle and see what is it. There's an early part of the cycle, which is things are growing. There's your mid part of the cycle, which basically everything's improving. There's the late cycle, which basically things are tightening up a little bit. Costs are going up, profit margins contract, policy tightens, which is kind of what we're seeing right now. And then there's the recession, which kind of resets everything and gets everything right back going. So the 4 cycles always remain the same. The part I think that's interesting about this slide is that look at the whole world. I mean, Kevin, look at that. The whole world is in late cycle. It's not just us. It's everyone. This is happening across the globe. And I will say this is, that doesn't necessarily mean that a recession is going to come. I don't want you to think that, okay, we're here, but we're not at the bottom yet. And I also don't want you to think that, late cycles are always 100% a good prediction of a recession, but it does give us a good idea of how strong our economy can be if something does happen. Okay, the strength of our economy if it had to wake up overnight and address something immediately. And I think that's where you would see is that obviously we're still in that late cycle. We're going through our own, retooling, if you will, right now. So again, we know where we're headed. It's just a question of when, and it's a question of how and how much. So again, we just do not see us at that bottom part of the cycle right now. So one of the things that we have tracked here that Kevin's going to review is just when interest rates go up, everybody gets nervous, right? Especially our conservative investors and people that are investing in bonds, because that's obviously any diversified portfolio, at least for a moderate to a conservative person, should have bonds in it, even though they might be boring. They're nothing flashy, but they're protection. So one of the things that Kevin's going to talk a little bit about is just the history of bonds with regard to Fed raising rates.
Yeah. And one thing that's unique about this year is that bonds have lost a significant amount of money. Aggregate bonds are down over 10% this year. I think I looked at the 20-year Treasury the other day, and it's down more than 15%, closer to 20%. And that's unusual because we've always looked at bonds as a safe haven, right? And so when stocks are really volatile and having a terrible year, there's usually a flight to safety. Bonds go up in value, and it's a good year in bonds. So, so that's a little bit unique, and I think we're going to get back to where bonds can become that safety area again. But if you look at the last, I think it's 8 rising rate periods that we've got here on the chart, and we can see how much the Federal Reserve raised the rates during that period. And we look at what we want to look at is how have bonds performed? Well, they actually went up and made over 2% during that period. We haven't seen that this year, but I think we're going to get back to that. But more importantly, look at what happened the 2 years after that rising rate environment. They average, and this is per year, about 12.5 to 13% per year. So we've got a chart here in a minute showing how income has returned to bonds, and we'll look at that. And so I think that bonds are stabilized now. You can get a good yield on it. So I think they're going to become more attractive, and we're going to see some much better returns going forward over the next couple of years. So our more conservative investors have not enjoyed this year looking at their accounts, but we just need to be patient, and we're going to be fine with this. Okay. The next thing I want to look at is how did stocks perform during the same rising rate environments? And we can see that stocks actually earned over 12% per year following those rising rate environments. So, and we know that about stocks. We've always known that they're a good inflation hedge. And so, you know, you've got Coca-Cola charging more for their products, and IBM and all the big companies are charging more for their products, and that should pass through to the bottom line for you people that own that company through the stock.
Yeah, it's amazing, some of those charts. It's just amazing because that's the biggest thing we see is just, you know, people are so concerned around just rising rates, and the great thing is equities. I mean, equities are a great inflation hedge. Mm-hmm. You know, not every equity works the same through these periods, but there's some great opportunities out there, and the stocks are a necessary part of a portfolio for an inflation hedge.
Sure.
So, two great points, and now we talk a little bit about. We went back. We've seen some history. Okay, we've talked a little bit about what may happen or how soon it can happen, and now we want to talk a little bit about what does this mean for the future. And I think this is where, you know, for our clients, you obviously know we're active managers. If you're not one of our clients and you're doing your own investing with another advisor, this is really where I think we differentiate ourselves. Is that, you know, we are here every day looking at these things inside and out. We are analyzing investments, analyzing portfolios, analyzing different sectors of the markets and the economy. And we have to look at that, obviously, and we have our bi-weekly investment management meetings where we're talking about scenarios. So I just wanted to kind of share with you some of the things that are out there. The 4 scenarios that we look at and we have been looking at. One thing I will mention to you too, and if you're with us, you would know this, is that, you know, towards the end of last year, when the market was soaring and everything was going great, you know, we were a little bit cautious. We were a little bit nervous. And the reason is because stocks became so overpriced. We began seeing inflation coming up as we talked about it. It peaked out at 7%. You know, those are definitely headwinds. Those are, you know, we look at those things, and that doesn't mean that we want to take all of our clients and say, okay, it's time to get to cash, because that's not prudent. You know, where you're invested with us is driven by your time horizon and your risk profile. But, you know, if you're not with us, you know, we were looking at these scenarios, and we did become more conservative at the end of last year before this came. Now, that's not us having a crystal ball. That's us being cautious and prudent. So I tell you that because we looked at these 4 scenarios, and we began looking at them last year before some stuff even came to fruition. So the first thing is inflation continues to rise. You know, recession pressures continue. Basically, it forces the Fed to raise rates, which is exactly what happened. That is really, in a sense, what has begun to transpire over the course of 2022. You know, the other thing was, you know, you just can't touch inflation. Recession ensues. Europe's deeply impacted. We saw some of those world economies. Everybody's impacted to some extent. The other thing is the peace rally. Now, we had not planned on, you know, one of the things we didn't see at the beginning of the year was the Russia and Ukraine thing. So, you know, what could happen with there? Let's say inflation remains high, but something happens from a peace perspective there, and that begins to transpire and things get more positive, or just the war worsens. It gets worse and worse and worse, and more people join in, and that's just going to fuel a longer term trade disruption as well as a recession. So these are really 4 realistic scenarios that may happen, and we do not necessarily know. Some of them have already started to happen, but we don't necessarily know how it's going to play out because a lot of those things on that chart are out of our control. It's up to us as money managers and financial planners to make sure that we are addressing these within our clients' portfolios and are prepared for which one of these 4 things are going to happen. But I just wanted to show you the slide, not to dive too much more into it, other than the fact that you'll see some say sectors that can benefit, sectors that may hurt. All stocks are not created equal. One of the things we've learned from the past is that, you know, certain stocks are going to perform better in certain environments. And it's not just about, are we in a recession or are we not in a recession? It's about what type of recession are we in? And it's one point I meant to mention earlier is that when you look at those gray areas that we looked at in recessions, they all were for different reasons. You had your tech bubble. That was a sector explosion back in the early 2000s. That was 3 years after I started my career. I mean, that was that was an eye opener. Then you had the credit crisis, COVID. I mean, completely different types of recessions. And I tell you that because this one, the one that's coming, will be different than those. Everything is different. So we have to be cognizant of that and understand what types of stocks and investments are going to be important to own in those things. So we call them market leaders. And I just want to show you this slide because sometimes we get people come in that manage their own stuff and they'll say, I always get it right. I get it right all the time. I've been right 100% of the time. Kevin and I both know that that could never, ever, ever happen because we can't do it right all the time. And the reason is because, yes, history does repeat itself in certain areas with interest rates and stocks, but it doesn't necessarily do that in stocks. So what I wanted to show you real quickly is market leaders would tend to say what type of stock sectors perform well before a bear market comes and after. So I'm just using two scenarios here. The tech bubble, which again is a completely unique scenario, and that was one sector of the economy that really brought the stock market crashing. Then you had the global financial crisis, which obviously was a completely different picture. But if you look on the left, it just lists a series of stock sectors. So you have information technology, consumer discretionary stocks, healthcare, materials, real estate, financials. And what it tells us is which stocks were better before the recession started, or before the bear market came and after the bear market came. So the only colors I want you to remember in here are the blues. Don't dive in too much other than the blues, but you notice the blues are a little bit everywhere. Now there's a few sectors here that jump off the page at us that I'm going to talk about, but you'll notice that very rare, very, very, very rare do you see the same sectors performing the best every single bear market we have. And it just goes back to the reason that I'm hoping that you'll understand is that every bear market happens for a different reason. There's always something different, even though there's some similarities. So again, there's no one thing that's going to be the best in any market. Now, we do think that there's some, I would say when a recession comes, being conservative and being in defensive stocks, and looking for dividend paying stocks and things that are going to be here no matter whether we're in a recession or not is very important. And I'll get to that here in a little bit. But the future means coming out of this, what's next beyond this? What are some of the areas that we see that might have some growth opportunity in the future? And there's a few of them that just still jump off the page to us. One is industrials. And I will say this is that, there's a lot of good things happening in industrials right here. We're not going to get through each of these individual stocks. I just like to point out a couple examples. You have Carrier. They're reducing hazardous waste by 23%. They've been doing it since 2015. Daikin, that's 98% of sales, is categorized now as environmentally conscious. That's up by 83% from 2017. These companies are moving in a better direction. And I still think it's going to continue. I think that's the way our world's going to continue. And we're seeing some areas here in industrials, I think, which are just making buildings more sustainable. If you ask us, what's the future, how things are changing, there's companies out there we see there's definitely some good opportunities in. So that's one area. Semiconductors, I say chips, and more chips. And we don't mean potato chips. We mean the chips you put in in everything that we use now. Think about chips. I mean, they jump on the scene 2015. We have them in our smartphones. Automobiles are run by chips now. We obviously know computers are in data centers. But just take a look at the value of a chip per unit. So 2015 on a high-end smartphone, I don't even know what a high-end smartphone was back in 2015, but $100 was the value of a chip. Now we're up to about $170 in 2020. By 2025, we're estimated a little under $300. The automobile, that's a big one now too. I mean, estimated up close to $700. And then the data center, obviously 56. I mean, these are estimates, but I will say that shows us there is definitely growth opportunity in some of these semiconductors that are out there. The other area that we just thought was really astonishing is I know some of the big tech companies made a lot of money over the last several years. They made a lot of money, but they were also hurt. They were hurt early this year when inflation came and the Fed raised interest rates. But one of the areas that I think we sometimes overlook is that, these tech companies, they have different areas of their business. The one that we look at is cloud. So if you just take a look at the cloud revenue business across some of the major computing service companies, so you have Alphabet, Amazon, and Microsoft, just take a look. And basically, that's just the company. So Alphabet's in light blue, Amazon's in dark blue, and Microsoft's in that teal color. The 4 years annualized growth by Alphabet was about 48%, Amazon 37%, and Microsoft 23%. Okay, so as of April of 2022, Microsoft achieved 32% quarterly positive quarterly growth, now taking in nearly about $100 billion in revenue. And I do not feel that this is going to go anywhere anytime soon.
No,
I mean, I do not feel it's going to stop anytime
keep
soon.
going up.
So yes, these companies were hit. Yes, we don't know. Obviously we can't say they're not going to be impacted again by the continuation of rising rates and things like that. But there's some definite areas in these companies that have good value to them. Other thing is healthcare. And we've been talking about it for years. Healthcare. I mean, obviously the innovation of healthcare is tremendous. A couple things I just wanted to show you on this slide was on the left-hand side. Basically, we're looking at the valuation. So the pricing of healthcare stocks versus the larger market. And the only thing I would ask you to take from this is anything you see in red is when, or let's say that reddish purple is going to be when healthcare is more expensive and relative to the market. And anything you see in blue is where it's less expensive. And take a look at where we are right now. Well below the average line, which means that there's some good buys out there within the healthcare industry. The one thing I point out, because I just think it's so big, I mean, I have family that's been impacted by cancer a lot. I'm sure everyone has out there, just to see the evolution of these companies trying to fight cancer. I say the ADC cancer therapy market. If you don't know what that is, that's antibody drug conjugates. They empower the immune system to treat cancer cells while leaving healthy cells alone. This has been around for quite some time. We've been looking at it. 2020, it was about a $3.2 billion market. Now, by 2028, we're anticipating that to be a $20 billion market. So we do think there's some areas out there that are going to continue in the healthcare arena that definitely are going to be attractive. So these are just some of the things we're looking at for the future. Rising dividends, I mentioned it just because I do think it's important to say in times of recession, sometimes there can be challenges and not every stock performs well. And sometimes dividends do matter. It used to be, and Kevin and I were talking about this yesterday, used to be dividends when you're in a recession would be like, or you're heading in, it would be like you could get dividends from only certain asset classes. What was the ones you mentioned? The biggies were
utilities
and
energy,
right?
Have always been strong.
So look at this. I mean, utilities and energy, used to be the big, and they're number 2 and number 3 on the right hand side. But look at where we are right now. So global dividend payments have risen over 20% to 1.9 trillion over the last year. But look at this. Kevin mentioned 2 of those things on the right hand side. Look at the dividends across the board amongst different asset classes. That tells us that rising dividends are good, but it's not just going to be about 1 or 2 types of sectors of the economy anymore. Now, if a recession comes, yes, it might go back to different things, but right now there is some attractive yields right now. And it's not about, when we look at companies and things to invest into, we're not looking for companies saying they're going to make a 4% dividend, then they come in at a 1% dividend. We are looking for companies that have sustainable dividends over time, and their dividends are coming in closer to where they should be. So that's an area where we'll continue to look at as well. And then Kevin mentioned this real quickly, is income is returning to fixed income. We had to take the income out of fixed income before. But just take a look to Kevin's point of how interest rates have changed. Take a look at where some of the yields on fixed income were, basically a 2-year treasury, recent low. They are some low, under 1%, under 0.5%. Even corporates, high yield corporates, 3.5. Take a look at where they were from their low earlier in the year to 6/15 of this year. And I'm just going to share a couple. You have the 10-year, you have the 2-year treasury up over 3%, 10-year. Look at high yield corporates. What an explosion, and what a great way to get back into the bond market to get some yield. 3.5% now to over 8%. So income is returning to fixed income, and we do think that's a good place for us to be looking at right now. So, I'm going to kind of stop there because I do think that's a lot of information. But what I wanted you to gather from that is that we have a good eye on this. We know what's happening. We know what has happened. We're not sure when the next thing is coming, but I wanted you to all see, especially if you're not working with us, that we have a pulse on this market. And we will be able to pivot in that pulse driven by what's right for you. Now, I will say, no one knows when the recession's coming, but we do feel as a firm that, from an investing perspective, we're going to go back to the fundamentals. We're going to go back to the good old fundamentals of what a company's worth and the price and the earnings and all that fun stuff to really see what's valuable out there. And yes, there could be a recession. It may be a moderate recession. It may not be as tremendous recession as people think, but that's okay. And I hate to say that, but a moderate recession may be okay down the road because we have to be able to clean up some of the stuff that we've been experiencing and some of the excesses that we've been dealing with since the start of COVID. So we're not scared of a recession, because we can't be. We're in that business. But we also don't want you to be either, even though it's hard to say that. We want you to be prepared, which is why, truly we say, with the help of a financial planner and investment professional, we truly believe that the world, the industry itself is transitioning to really see the value of what we do as financial planners. And this chart here, so this chart that basically shows us working with a financial planner. And I think a couple parts, the colors I would ask you, or be the first thing I would ask you to take away from the slide, is the yellow and the gray. Anything you see is in yellow is good, and anything you see in gray is not as good. But take number one, the yellow, with regard to one thing, certainly outweighs the grays, but the optimism about personal finances or household finances. 78% of people working with an advisor felt, nearly 80% were optimistic about their personal and household finances. And isn't that really all that matters? Is basically the government and the Fed's going to do what they want to do, but are you comfortable? Are we confident about what's happening in your individual household? So that's one. A recession, would it have a major impact on my finances? Under 30% said yes, close to 40 said no. So the idea of this is that people that work with a planner, yes, a recession still hits deep down at the bottom of our stomachs, but people that are working with a financial planner are more confident heading into them. The total prepared for a potential year of recession right now, working with a planner, is nearly 70%. But here's the big one that jumped off the page at me. Since the last big recession, not COVID, but since 2008, the total more people that are prepared for a recession than they were are 65%. That's telling us that if you're not working with a financial planner and you're stressing out, now has never been a better time as we lean into what's coming next to be able to do that.
Mm-hmm.
So with that being said, how do financial planners help people gather this confidence? What can we do as planners to help our clients, navigate through these times?
Yeah, so I like that slide where it says, our clients feel prepared for a possible recession. And so the things that you can do right now is get with your advisor and review your current risk in your portfolio. That's, immediate. Review your 401k and your investment allocations there and understand that. Life beyond stocks and bonds, we do have a couple of other things that you can consider if you are interested in that, and things that we've been looking at. And then, of course, review the financial plan. Okay. So as far as reviewing your portfolio risk, our clients will recognize this. This is our risk analyzer software. And we use this tool to evaluate your current investments in your portfolio. And we've got historical data going back 14 years of daily returns to calculate the volatility of that. And we look at this and we see, if there were a major pullback in the market going forward from here, what would that likely do to your investments? Okay. Now, of course, the future is not going to be like the past. We know that. But it's 14 years worth of data, and it's very helpful for having these conversations. So if we look at these results and you don't like the way that looks, but more importantly, if it causes you anxiety or fear, or is going to affect the quality of your life or your relationships, or you're going to lose sleep, and then we need to take action right now. And we can take action today and move you into something more conservative. Okay. Of course, we've got strategies that go from ultra conservative all the way up to aggressive. So that's number one, is review the risk in your current portfolio. Equally important, though, is review your financial plan with your advisor. So Matt, we've both had a number of clients over the past couple of months calling us and a little bit concerned about what's going on. Come in here, sit down, let's go over the financial plan, let's take another look at it. And what we find in most cases, that once we look at the long-term financial plan, we see, well, I'm still on a pretty good path here, right? I've still got a high probability of achieving the retirement goals that I had set out. Now, of course, there's an impact when markets go down like this, but there's different things that we can do. We can look at different strategies and options and make some changes in your planning, your contributions. You talked earlier about saving more right now. That's an excellent strategy for today. But again, most of our clients, once they've sat down and looked at their financial plan, they felt a lot more comfortable. And that's reflected in the chart we just looked at as far as, hey, when I'm working with an advisor, I feel more comfortable that I'm going to be able to handle this. Make sense?
Absolutely.
And then the last point here to talk about is, are there alternatives besides stocks and bonds? You know, and to talk about that, I like to talk about 3 different kinds of investors. These aren't the only 3, but 3 main categories, right? We've got stock investors, bond investors, and then some that are even more conservative than that. Our stock investors are saying, largely, you know, right now, I want you to stay in stocks. And so that's what we're doing, right? These are investors that have a 7-10 year investment horizon, moderate aggressive or aggressive risk tolerance, largely. And so we're staying in stocks. As you pointed out, we're actively managing that. And so we're analyzing which sectors are the right sectors to be invested in now and going forward. You mentioned a few of them that we're actively investing in: cloud computing, AI, robotics, healthcare, of course, and industrials. So that's one thing we're doing. But we also have some buffered strategies that if you're someone who feels very confident that the market is going to go down and you want some kind of alternative there, we do have buffered strategies that will limit your downside, give you a 10 or 15% buffer, for example, with a little bit of a cap on the upside. Again, these are liquid strategies. So there is something there for our stock investors. Feel free to reach out if you want to learn more about that. Our bond investors, as we mentioned earlier, we like where bonds are headed going forward, but we do have some alternatives that we're investing in. We're in TIPS, or Treasury Inflation Protected Securities, and a little bit more into real estate, and then also some short positions or investment strategies that will do well if the market turns down. Lastly, for our more conservative clients, these are people that have been accumulating cash in their bank account because they just didn't know where to go with it, or they didn't feel comfortable in anything else. We do have a strategy for these clients, which is liquid, 100% liquid, provides you complete principal protection, but you could still earn 1 to 4%, something nice conservative return, depending on your personal situation and how the markets perform going forward. So that's a really good option too. If that sounds interesting to you, please reach out to us and we can talk more about that. So Matt, do you want to talk a little bit more about blind spots in the future?
Yeah, I think, just, and Kevin did such a great job, because obviously there's so many things we can talk about. And again, everything that, we don't know, if you're a client of ours, we obviously, we have that trust. We've gotten to know you and we know where things are. But if you're not a client of ours and you haven't seen some of these things, we would encourage you at the very least to reach out to kind of see where you are, with that financial planning, and Kevin mentioned it, but, coming in to see us and understanding, okay, yes, we can't control the world, but in your world right now, this is where you are, this is what you have, and this is where you can go to by doing 1 or 2 or 3 minor modifications. That's key right now. Our clients, obviously we can't guarantee that we will never lose money regardless of what's happening. I mean, everyone lost money in the first quarter. There was no doubt about it, unless you were in some guaranteed product. Everyone lost money. So the idea of this is that we can't necessarily say that, we're not going to, and again, we're certainly not managers that are going to go in and out of the market, because we're not timers. But the financial planning part, when you see the biggest benefit in the financial planning side is being able to put a plan in place with certain action steps. And what helps our clients is when they come in to see the action steps that we've been putting into place, they get to see the results ongoing and how much it's positively impacting their overall scenarios. That is more than anything and to me, that's the best thing we could ever hope for, is giving our clients the ability to see their progress when we put these action steps in place. Because, we could go into recession tomorrow, and that's the reality of it. Something could happen and that we can't foresee, and we could be there. And everything we've said today could go completely backwards. The reality is our clients are set up for that already. We know what's going to happen and we know where to go with it. So if you have not had a chance to really look at financial planning, or I will say this, is we've taken on a few clients here recently that have said, Matt, over the first quarter, after the first quarter, we have just walked away from it. We're too stressed out. We don't want to touch it, and we're just going to put all our money in cash, and we're going to wait to see what happens. And I'm not saying that cash has not been a good place to have money, because it has, but there has to be a plan forward. There has to be a next step. How do we reemploy? If you're not retiring tomorrow, having all your money in cash is probably not appropriate. And having all your money in one area versus the other may not be as appropriate either. It's having a plan in place to navigate over the next 6 to 12 to 24 months is key. So what we help our clients do, as you well know, is we help you identify blind spots. You could think, if you're not working with us and you're doing your own investing with another advisor, you might say, I'm completely good, we're all set up. And you very well may be. And if you met with us and we saw that, we would be the first people to tell you that. We love telling people great news about their story. We are not, so you can tell, we're not doom and gloom advisors at all. We always love to see the positive silver lining of every scenario. But sometimes there are blind spots, and taking a look at what they are, how they could impact you, but then more importantly, taking a blind spot and turning it into something good, a silver lining. How can we take a silver lining and show you how that will impact you for the long term? So I keep saying long term because that is really what this is. I'm sure you've heard this as investors at some point. It is long term. If you're retired, it's still long term. We have retirees that retired this year and they're like, oh no, I retired at the worst time. No, this is your retirement. We're going to help you enjoy it. You still have a long term. Okay, so it's a long term perspective that we ultimately believe will win the day. So, I appreciate your time today. We've taken you back to 1985 with some movies. We've taken you back into history when rates and everything looks similar to the way it does right now. We've taken you back to showing what the Fed's done and how it's impacted interest rates and bonds and investments. We've taken you back to the unemployment rate. We've taken you back to different things that are happening in our world right now. And again, it's not the same exactly, but it's very close. Kevin mentioned some great things that we can do as far as active management and how we're addressing this. Know that we have that pulse on it. And now that I would say the future is really up to you at this point. The future is up to the Fed, but the future in your mind is, if you're with us, always keeping us informed about what's happening in your world. Changes, raises, concerns, budgeting, the future from your perspective should be making sure that our communication is key. We have that, we have a complete knowledge of everything that's going on in your world so that we can plan more effectively. And if you're not with us, the future can start today. We simply, we do everything complimentary. We are fiduciary, fee-only independent advisors. There is not a single thing that comes out of my mouth or Kevin's mouth that is not in the 100% best interest of our clients. We look at things, we do complimentary consultations. That's what we would offer. If you're not with us, we'd love to obviously take some time to get to know you, even if it's not the right fit. But if you'll get a pretty good idea of what a day in the life of a client of ours would be if you did that. And at the very least, hopefully you'll get a better understanding of where you are. And if you are concerned, give you some more confidence as you lead into some of these unknown areas. So we thank you for your time. We welcome your feedback. So when you see us, tell us what you think. If it's not reading for a while, just shoot us an email and let us know what you think. We want to make these things better. We want to be able to deliver you the content that you want to hear that helps give you the confidence moving forward to know that we know what's happening. Kevin, is there anything you want to?
No, that's great. Just thank you so much.
Thank you so much. We hope you have a great continued summer, and we will look forward to seeing you here at the office soon. Take care.